In the months ahead, credit unions versus bank. Why does Ben use a credit union for his mortgage? And why am I talking in the third person? How the wash sale rule works when you own a stock like CrowdStrike that just crashed. Tax implications of an income-based student loan plan. Some tax strategies for selling a rental property, and index funds versus financial advisors when managing money for retirement. Remember, if you have a question for us, askthecompoundshow@gmail.com. Our inbox is full every week. Really good questions from everyone. Today's show is sponsored by Fabric by Gerber Life. A lot of people email us questions saying, hey, I want to invest on behalf of my children. Ben keeps pounding the table on compound interest. I want to get them started early. Fabric by Gerber Life, designed by parents for parents to make it easier for you to manage your family's financial path. With a kid's investment account from Fabric, you can start investing in your child's future today. Funds can be used for anything benefiting your child: tuition, books, summer camps, after-school activities. When they're adults, if it's growing a lot, maybe you can use it for down payment on the first home, new car, all online. Setting up an account is very easy. Get started with as little as $1 a day. No minimum investments, no contribution limits. If you're a grandparent, I know we have some grandparents maybe in the chat.
Shout out grandparents.
That's a gift that keeps on giving to your grandchildren. Set up an account for them. Join the thousands of parents who trust Fabric to protect their family. Start investing in your child's future today at meetfabric.com/ATC. That's meetfabric.com/ATC. And they have cute kids on their website, which helps.
Good name today, Ben. I like that. Yen Carlson.
See what I did there?
I mean, it's already kind of old news now, right? I had questions about the carry trade for you and stuff, but it seems like everyone's forgotten.
Someone in the live chat asked how they can take part of the carry trade. My only advice would be don't do it. All right, let's get started.
Up first today, we have a question from Nick. I've accumulated quite a bit of the T-bill ETF as readily deployable cash with the added benefit of earning about 5%. My question is, do you see holding too much T-bill as an opportunity cost versus adding more to the S&P 500, especially now that rate cuts are on the horizon?
Okay, so T-bill ETF is 3-month T-bills effectively. I've been getting a lot of questions on this lately about what to do with an allocation of T-bills. People, it just 5% yield for, I don't know, a little over a year now. It's juicy yield, no volatility. It's been really nice. But now investors are worried about the other side of that, right? The market is pricing in something like 100 basis points in Fed cuts by the end of the year. Market could be wrong, of course. It's been wrong all year. But it seems inevitable that at least September, probably November, maybe December, we'll get Fed cuts. I don't know what the magnitude's going to be. And when the Fed cuts rates, as we saw last week, the Fed funds rate tracks the T-bill yield pretty good, or vice versa. So those yields will be falling. Obviously, there's a difference between holding a pile of ready deployable cash, like this person is doing, and then an allocation to cash as an asset class. So over the long run, cash is all but guaranteed to lose to stocks. 1928 to 2023, stocks did 9.8% per year in the U.S. Cash, which is T-bills, that's what we interchangeably hear, we're up 3.3%. If you add inflation of 3% on there, which is what it was, we're talking 6.8% for stocks per year over the rate of inflation. Cash was 0.3%, so barely over the rate of inflation. So over the long term, stocks beat the pants off of cash. In the short term, though, cash can act as a useful hedge. So in the 96 years ending 2023, 3-month T-bills outperformed the S&P 500 31 out of 96 years. We're talking 1/3 of the time, cash beat stocks in a given year. And the average drawdown for a down year for stocks, so anytime the stock market was down in the U.S., it was like a 14% drawdown. In those years, cash was up roughly 3.5%. So we're talking a 17+% spread between cash and stocks in down years for stocks, so that works pretty good. In 2022, stocks and bonds both down double digits. The S&P down 18%, 10-year treasuries down almost 18% as well. Cash was up more than 2%. So cash, in a rising rate environment, in a volatile environment, in a down stock market year, cash can help. The problem with the current short run is if you just decided to time it with that 5% yield and you got out of the stock market, or you were allocating to cash when you would have been putting in the stocks, you missed the market by a handy margin. John, throw up my chart here. See what I did there, Duncan? That's called Microsoft Paint. T-bill yields hit 5% April 2023 for the first time. In that time, the S&P 500 was up roughly 32% in total. So if you won all the T-bills because you said, yes, 5%, that's great, I don't want to deal with market volatility, you missed out on a really big gain in the stock market. So that 5% felt mighty comfortable, but there was a huge opportunity cost by accepting that comfort. And this is what makes market timing so challenging. If you sold stocks in 2022 before the carnage hit in the bear market and you sat in T-bills, you said, easy, this was great, I feel awesome. But if you sold some stocks to buy T-bills in 2023 when they hit 5%, you miss out on some healthy gains. So the question is, okay, I could have done that, I could have done that, but what do I do now? You're sitting on this big pile of readily deployable cash in T-bill. Unfortunately, I always say there isn't much good advice when it comes to market timing beyond creating a plan in advance. So if you knew what stocks were going to do going forward, if you knew what the Fed was going to do, where rates were going to be, this would all be easier. But no one knows what the stock market will do. No one knows what the Fed's going to do, not even them. So I like to thinking about market timing when you have to do it like this. Requires some combination of market history, context, and regret minimization, right? So the stock market usually goes up. Nick McJulie's done some great work on dollar cost averaging versus lump sum. Roughly 3/4 of all years, the stock market is up. Pick any point in time a year later, the stock market's up 75% of the time. If I could go to the casino with those odds, I would. That's pretty good. But you have to think about it in the context of where we are. Well, we were up pretty big in 2023. We're up decently in 2024 again. That panic we experienced on Monday, maybe that's a precursor of worse things to come. I don't know. So most people would want to try to time the market when there's blood in the streets, but this is, I think, where the regret minimization comes into play, because if you just invest all your cash at once in a lump sum and the market rolls over, you're kicking yourself. If you dollar cost average and the market takes off more, you're also kicking yourself. But if you wait for a market crash that doesn't transpire, I think that's when you kick yourself the worst, because you're just waiting and waiting and waiting. And I think that's my least favorite option, is waiting for a crash, because they do happen, but it's pretty rare. And the problem with sitting in cash waiting for a crash is that cash becomes an addiction, because I'll buy when stocks fall 10%. But what if they go up 10% before that? And then you're more or less round tripping. Okay, I'll wait for 20%. Well, at 20%, it seems pretty scary. Now I'll wait for 30%. And then cash just becomes you got the Gollum with the ring, right? I won't do the voice, but
my precious.
Yeah, it becomes your precious. So I think the longer you wait for a correction to occur, the harder it is to put that money to work. So I think that there's just this psychological malfunction in an investor's brain when they miss out on big gains. So I think the longer you wait, the harder it is to actually invest. So this is why I just prefer an automatic dollar cost averaging strategy. You make the buy decision ahead of time, choose a time frame. I don't care, weekly, bi-weekly, monthly, whatever it is. Split up your purchases in equal chunks. Buy at predetermined levels. Most brokerages and fund providers let you do this, right? I'm automatically going to invest every other week for the next 6 months, 12 months, whatever it is. The time frame and the amount probably don't matter as much as just picking a plan and sticking with it. And obviously not a perfect strategy by any means, but the perfect strategy is only going to be known with hindsight. And if you want to have a little tactical element to it there, you can say, hey, listen, if stocks fall 15%, I'm going to speed up my purchases a little bit or make an extra one. Or if they fall 20%, I'm going to invest a little bit more. So I think that, short of being able to predict what's going to happen with the markets, which no one can do, I think that's the easiest way. You just have to make sure you have a plan you can follow and then stick with it, and don't worry about what the market does from there. Follow the plan, come hell or high water. That's how I put my T-bills to work.
Did you make any tactical trades on Monday?
No, I made an automatic trade, though. It just happened that my bi-weekly trade kicked in on Monday. Now, if the stock market kept rolling over, I would have said, shoot, I'm kicking myself for that. But it's out of sight, out of mind. That's why I think that's the best way to do this.
I was happy to hear.
Second guess yourself.
It sounded like a lot of people, that I talked to or that I saw on social media were kind of complaining that they didn't have a chance to buy as much as they were wanting to. So that was nice to see. Instead of people panic selling.
Are you sure that's not kind of like your friend at the bar who's saying, hold me back, hold me back. I'm going to beat him up, I swear. How many people were really trying to panic sell? It's a little easier to say after the market comes back. I'm just pointing it out.
I mean, maybe, but yeah, I was buying.
All right, way to go, Duncan. All right, next question.
Also, I should point out, Sean in the chat is saying that Oatly's beating the S&P today. So that's pretty nice. Pretty nice to see. Okay.
Alpha.
Yeah, there you go. All right, up next we have a question from Dave. On today's show, Ben mentioned his HELOC. That's a home equity line of credit for those new here. You mentioned that it's through your credit union, not a bank. Might be a good topic for a future show. Why does Ben use a credit union instead of a bank?
All right, I think this is straight from Dave in the live chat, who's always here with us on a weekly basis. Appreciate that, Dave. I wish I had a really good, thoughtful financial answer for you here, but the truth is our builder had a preferred relationship with a credit union, and they said, you can use any mortgage lender you want, but we prefer you use this one, and it'll be easier for the process. And we said, okay, we're using a credit union. That's it. It was. I mean, I think there are some benefits to using a credit union. You get slightly higher yields on your savings and CDs and stuff, and maybe some lower yields on your borrowing. Although the mortgage rates that we've gotten, and we've refinanced a few times with this credit union, are pretty much market rates. I haven't noticed any huge bump that we get by using them. I actually used a bank for my first mortgage, so it's not like I sought out a credit union. It just so happened to be that that's the one I used, and that's it. So, I don't think there's like a gigantic advantage you get by using a credit union. But ours was just ease of access. That's it.
I mean, what's the basic difference? Are they like a nonprofit, and so
Yeah,
they're not actually trying
Right.
to make profit?
And
Is
so-
that the idea why they can offer better rates?
Yeah, and it's so, I don't know. I don't know the best way to explain this, but yeah, they're not like public companies. So
Because a lot of times you see they're for employees of a specific company. You know what I mean? They'll have their own credit union.
yeah, and sometimes it's hard to get into, or it takes a few steps to get into one. So, but yeah, I haven't really noticed that it's like that much of a better difference. It probably is for more things like savings accounts or getting some interest on your checking or CDs or that kind of thing. But we just did it because it was easier.
Okay.
That's it.
And well, you don't have to worry as much like me having 2 banks closed down in the last year. You know, so
I mean, you literally put your money in a bank called ZURP. What did
Yeah.
you think was going to happen?
I mean, it was spelled ZURP. You know.
That's even worse. All right, next question.
All right. Up next, we have a question from Bezod. I bought CrowdStrike 2 days before the outage, and it's been bloody carnage. Just my luck. I've lost around $6,000 and counting. I recently learned about the wash sale rule and how you can sell your stock, wait at least 31 days, and then buy back the same stock to offset your gain with the loss. One website stated that you have to wait 61 days, 30 days before and after sale. I just want to make sure I'm doing the right thing and nothing illegal. So can I actually sell all my CrowdStrike stock and then buy it back at a cheaper price and still use my loss? If so, how many days do I have to wait to buy it back? And
It's
just
kinda
to be
funny.
clear here, it's not so much an illegal thing or anything, right? It just means you're going to pay taxes that you wouldn't otherwise pay.
Well,
It's
we'll
not
get
like
our
you're gonna
tax
go to
expert
jail.
on this. Well, we'll see what our tax expert says. Maybe you go to jail for what are you in for? I killed a guy. What are you in for? Wash sale rule.
Oh my God.
It is funny. I always say that like no one actually ever buys at the top or sells at the bottom or whatever it is, but someone has to do it, right? And so this guy bought 2 days before a crowd. CrowdStrike is down 40% or so from the high. So let's
Yeah.
bring in the Rothman himself, Bill Sweet, to explain this one to us.
Hey, Bill.
Yeah, tax losses. We're back. We're back, baby.
So
There you
the
go.
idea of this rule is you can't just make a sale when the market pukes, lock in the tax loss, and then buy back again because no, the government says no. So how does the wash sale actually work?
Yeah. I want to correct Duncan. What happens to Bazad if he sells this and rebuys it? A thunderbolt comes down from the IRS and smotes him on the battlefield.
There you go.
No, this is a common question, and it is exciting, Ben, to be back into the world of volatility, right? So we get to discuss these things because this is when you guys break me out of my cage.
Yeah, taxes
So-
come to play.
Exactly. So Bazad is correct. You can buy the stock anytime you want. You're not breaking the rules. But what Bazad wants is he wants his CrowdStrike gains, and he wants to eat the losses too. And so that's when the wash sale comes in. And to kind of illustrate the timing that is around this, in order to realize a tax loss, there is a 61-day period when thou shalt not repurchase a security. So, John, can we chart on chart number 1 here to illustrate the
They
difference?
should have done 59 and a half days just to make it simple like everything else.
or 70 and a half per the RMD rules.
God.
Yeah, so if a sale were to happen today, gentlemen, on the 8th of August in the year of our Lord 2024, any purchase that happens between now and September 7th would be considered part of that wash sale period, right? Because it's a 30-day period after the day of the sale that matters for wash sale purposes. And in the event that Bazad repurchases the security in that 31 days, again, no thunderbolt actually comes down. What happens is your loss just gets carried forward with your basis. You're not able to recognize the $6,000 of Bazad's capital losses in the current tax year. So it's not the end of the world, but in order to benefit from the loss, to recognize it on a tax return, you would have to wait until September 7th or later in order to benefit from
So
the loss.
he sells today. He could turn around and buy it back in 30 or 31 days or whatever it is.
Correct. Yep. And then you
Okay.
get to book the loss and you repurchase security, right?
Now, how many investors have the intestinal fortitude to sell a stock that's down and then buy it back 1 month later? Because what happens if, I don't know, the stock comes back in the next month.
And I
he
would
misses
argue
out on
like,
some gains.
yeah, economically, the loss has happened, right? So, like, if you're going to sit out for 31 days, like, it could go down by 10%, it could go up by 20%. I think the issue is it just removes some of the timing advantage there. So, John, can we pull up that chart just one more time? Because I do want to illustrate another quick point. So the 61-day period extends for 30 days prior to the sale. So really smart people, I don't know, in the 1920s that were gangsters figured out, hey, if I just buy the stock a week before I actually sell it, right, to book the loss, so you basically double down on the purchase. That's a covered purchase too. And so any stock that's purchased before the sale would also trigger the wash sale rule. It's basically a way to prevent people from buying the stock first and then recognizing the loss.
Right. He couldn't double up,
correct,
sell it, then hold his same position. That makes sense.
Correct. And then to get to Bazad's question, that's where the 61 days comes from. It's 30 days prior, 30 days after, and then it also counts the date of sale. Add all those up, you get 61.
We always talk about having the tax tail wag the investment portfolio dog.
Right.
Is that loss really worth the potential gains you could be missing out on if the stock goes up? Now, the stock could roll over and he looks like a genius.
Right.
But I don't think that's the reason you want to say, I'm going to lock in a loss just because the stock is down a lot.
Yeah, it's a great question.
I think you have to figure out if you want to hold the stock or not, and then if you don't, sell it. If you do, hold on to it.
That is a good point. Counterpoint. There is economic value in recognizing that loss. So each taxpayer, you, me, Ben, Duncan, we are allowed to deduct $3,000 of capital losses against our ordinary income every tax year. And so if there's a $6,000 loss, that's 2 years times $33,000. Let's say Bazad's tax rate is 30%. That's $900 a year, right? So for the economic value of just selling the stock, waiting 31 days and rebuying it is literally $1,800. It's not a bad thing. It just puts a lot of pressure and stress onto what happens in that 31-day period when you're not allowed to buy.
That's the thing. It's a roll of the dice.
Yep. No free lunch.
Also, two other things for our newbie investors. You cannot sell for a loss in your brokerage account and then buy it immediately in your Roth.
Correct.
Right, that will trigger the
That's
wash
when the
sales.
Thunderbolt comes down from Mount Vesuvius. Yep,
and then the other thing is it also applies to options, right? Options can mess this up for you.
Yeah, exactly. I was going to go there, Duncan. You should be hosting this show at this point.
No, trust me, I just know because I've messed up. I've triggered the wash sale rule.
Yeah, substantially identical security is the term, and yes, a call option, the right to buy a security at a certain price, is substantially identical to a CrowdStrike stock itself. So therefore, the IRS says no, thou shalt not purchase a call option, even if it's in an IRA, even if it's in a trust that you control the majority of. You're exactly right.
What
Duncan,
would be
the tax man?
What would be a similarity of crowds? Let's say you said I'm going to buy Cloudflare or Salesforce. I don't know what's a
or whatever.
You could sell CrowdStrike and say what's a stock that's kind of like it. You could do
Yeah.
that's risky also. But you could
It
do
is risky
that
because they're different companies. Yeah, it might have a different balance sheet and different income statement, and therefore they're not identical securities. So yeah, you can buy crowd farts, whatever else you'd like. Go to town, but there's no exact definition of what defines a substantially identical security. It's sort of like the famous tax court judge. He knows pornography when he sees it, right? But there's no written definition. I think in general, it like straddles, for example, if you hold more than a 51% ownership stake, roughly, that's substantially identical.
What about ETFs? If you have like a NASDAQ ETF and then you just sell it and buy another NASDAQ ETF?
Yeah, tax community is pretty split on this. There's not an exact clear, but I would argue that CrowdStrike is a very small percentage of the NASDAQ. Therefore, I would not consider it.
Oh, no, sorry. I just meant in general, wash sale rule wise. If you sell a NASDAQ ETF and then buy another one, is that substantially similar or are they different enough?
Like I said, there's a lot of debate in the community. My opinion is if it's tracking the same index, so if it's QQQ versus whatever the Vanguard version of that is, I would argue that is substantially identical.
Okay.
But if it's a different security, let's say the index, the Russell 3000 versus an ETF that's the S&P, I think that's substantially different enough. So, yeah, there's no hard definition. Again, it's like pornography. I hate to bring that up again, but I know it when I see it, Duncan.
Okay.
It's not good for you.
Up next, we have a question from Chuck. Longtime listener. I grew up in the Midwest and have tracked my net worth in a spreadsheet since college, so I relate to Ben in a lot of ways. My fiance and I are 27 and getting married in a few months, so we're preparing to combine our finances. One issue that has come up is student loans. She has $90,000 in loans outstanding and is currently on an income-based repayment plan, or IBR, which means that if she makes the minimum required monthly payment based on her income level, the balance of the loans will be forgiven after 20 years. She makes about $75,000 a year, Since we live in an extremely high cost of living city, she really hasn't been able to save much or pay down her loans. The minimum payments don't even cover the full interest, so the balance is actually growing each month. I work in a high-stress industry making around $350,000 a year and expect that to keep rising. My net worth is somewhere north of $400,000. Slide 2. My question is what to do about her student loans. Should we file taxes separately for the next 20 years so she can stay on the IBR plan with low monthly payments and eventual loan forgiveness? I'll feel like a sucker if I drain my savings account and put off investing in order to pay off a loan that the government will forgive. But at the same time, it feels risky to let the loan balance compound for 20 years under the assumption it will be forgiven, particularly since I have the money and income stream to pay it off at any time. What if laws change or she ends up disqualified from loan forgiveness for any reason? Also, are we missing out on significant tax benefits by not jointly filing?
All right. Bill, explain to me, why does it matter how you file your taxes for this? I've never heard of this before. Is this a thing?
Yeah, no, it is a thing. And yeah, it's based on income-based repayment. So it's a provision within the student loan code to help people who have high student loan balances, but they don't quite have the income to cover it.
But you have to file separately if you're doing this.
Yes, because each taxpayer is considered an individual entity, and therefore, if you're filing separately, Mrs. Chuck's income is $75,000, but if they file jointly, it's $450,000, right?
So weighing the pros and cons, is the benefit of that loan repayment worth not getting the benefits of filing jointly?
Exactly.
What say you?
Exactly. Well, I did some math, some quick spreadsheet math. I'm not going to share the whole gory details, but a $90,000 loan, Ben, at 6.5%, is going to cost about $5,500 in interest this year, right? One of the scarier things, though, from the question, slide 2, 3, 4, 5, one of the questions was that the loan balance is going up every year, right? And so that's particularly scary. And furthermore, the federal loans, they follow an index, right? So like if interest rates go down, like the interest payments will go down. But he brings up a really, really good question, is that if Chuck and Mrs. Chuck are getting married, they would have an option to file a married filing joint return, right? And so what would be the benefit there? And Ben, I have a question for you. Would you, in order to save $5,000, would you lose out on $13,000 of tax deductions?
I hope not.
Yeah, so that would be a silly point. So John, can we pull up chart 2, please? So if we take a look at, for me, I did some math, and even in a high tax state, the benefits to kind of put things in dollar terms, filing separately, 2 returns filing separately, where Chuck listed out the income, compared to jointly, the federal tax savings is significant. I mean, that is not anything to shake a stick at. 3% on $450,000 of income. Turns out that adds up. I did a state tax reduction in New York. You can see a bit of a marriage penalty, which is no good, but hey, them's the breaks. But New York, like many states, if you file jointly at the federal level, you're not allowed to file separately at the state level. So you got to take both the same pie. And it looks like Chuck and Mrs. Chuck, so Chuck would save close to 3% of their after-tax income by choosing to file jointly. So $13,000 of savings per year on a tax basis, to me, does not write off the benefit. It doesn't even compare. It's 2.5 times what the benefit of an income-based repayment for. So I think
that's a bigger difference than I was expecting to see. John, throw up a little fast facts. I pulled this from the federal government website on these loans, and it talks about how each year you have to update your income and family size, and then 20 years later you can, and it's based on a percentage of your discretionary income. The problem is 20 years is a long time. What if your wife ends up making way more money?
Yep.
And that the balance of the value of it goes down.
Yep.
So, to your point, filing jointly probably makes more sense, and then getting a more reasonable payment in there.
Yep.
Right? Like it sounds awesome to be able to use this plan and be like, yes, we're writing it off after a while, and we're going to stick it back to the government. But it sounds like the downside outweighs the upside here.
When you're after a while, it's 20 years. That's a long time to wait.
That's the problem. 20 years is a very long time to wait.
Yeah, and compound interest makes a big dent, right? So like if I look at the spreadsheet math, it's something like $93,000 of interest that you're going to end up paying over the course of that period, right? The Rule of 72 cuts in both directions. So therefore, my argument would be, look, like bite the bullet. I think it would make more sense. Take that tax savings, take the $14,000 of tax savings you're going to get by filing jointly post-marriage, and plow that into paying off that student loan as soon as possible.
Perfect. All right.
Yep.
Next question, Duncan.
Okay, up next we have a question from Matthew. I have a rental property that has appreciated a lot. I'd like to take the gains and exit my days of being a landlord. One thought would be to put the proceeds of the sale into VOO and use that account to pay my primary mortgage. But I don't like the idea of paying off my house when my mortgage rate is 3%. My biggest question pertains to taxes. My wife and I are both high income earners. Does this strategy make sense for us, or are we increasing our tax liability? Are there strategies we could implement with this plan to reduce our taxes? Hold on to the funds for more than a year, beginning to withdraw them so they're long-term capital gains. The thought of not having to worry about a mortgage would free up funds for other investments and allow my wife to retire early. What's the tax-efficient way to execute this plan?
All right, so let me get this straight. Matthew wants to sell his rental property, put the proceeds to work in the stock market, and then use that stock market account to pay down his primary mortgage. So instead of taking the whole big pile that they make on the, and I think about this a lot for people who have a rental property, that it has to be tempting to sell it because the depreciation is so large the past few years. But it seems like a form of mental accounting to me, though. The way of they're thinking at it. So use those proceeds, slowly spend on the stocks, and the idea is, well, the stock market is going to return much more than 3%, or even lower than 3% with the tax benefits you get on that. Why wouldn't I leave it in the stock market, let that compound, and then pay it off? I just don't know if this is the right way to think about this. It seems to me like they're taking one extra step and making it too complicated. What say you?
Yeah, it's a really complicated question, and to me, Ben, there's no clear answer. There's only trade-offs. So what Matthew listed off at the start is, hey, I kind of want to get out of the rental business, right? Because it is a business. Ultimately, you're running a small business. You need to do leases. You need to fix toilets. Like,
Are you still a landlord, Bill?
Yeah, I am, and believe me, it's not the most fun in the world, right? Is the juice worth the squeeze? For me, it is, right? Because I also run a business through that property. But for Matthew, it sounds like he wants to simplify his life. But like any typical real estate investors hate paying taxes more than they like making money, right? And so what Matthew wants is the best of both worlds. The answer is you will be increasing your tax liability. If you sell an asset, you're going to have a capital gain. And not just that, Ben, but rental properties have this feature of depreciation where you're depreciating the value of the property over time, depending on how long you've owned it. Usually 27 and a half years, there's a depreciation schedule. Well, what happens when you sell the property is you have to recapture all of that depreciation you took as a deduction in prior years. So it's not just the depreciation that Matthew's going to have to worry about. It's more
You're
than
taking
likely,
those tax benefits up front.
Correct. The benefits that he took years ago are all going to come into the sale. And so I don't have an answer for Matthew, but I have a couple of things that Matthew could think about. First, number one, you will be increasing your tax liability. So one solution, Ben, that we've rolled out a direct indexing platform for our clients called Canvas, run by our great partners at O'Shaughnessy Asset Management, Ari, Pat, a lot of great people over there. And what that has the ability to do is realize losses on an investment portfolio, and those can compound and build up against gains in, let's say, a real estate portfolio.
Right. If Matthew owned CrowdStrike, it would make sense for him to sell it because he wants to build up losses to offset some of the gains he's going to be having from the sale of the house.
He needs to give his buddy Bazat a call from question 3 and do a little gift tax transfer.
There should be a market for that. Like, someone should be able to purchase all the losses Duncan has in his personal portfolio of Oli stock and be like, hey, I'm going to buy those losses from you to offset my gains.
I'm having a pretty good week comparatively.
So that's one option. But another option, wait for a low tax year. You know, if Matthew's in control of his destiny, they're two high income taxpayers right now. Well, maybe Mrs. wants to take some time off. Maybe we're going to take a sabbatical, something of that nature. But the other thing, Ben, I want to throw in as a last option is a Section 1031 exchange. Have we discussed this on the show? I'm not sure.
I don't think so, but I know I've heard of it. And
I don't think
very
so.
excited too.
Yeah, and so it's a feature for real estate investors specifically, and it allows them to basically roll gains from a property. It allows you to sell one property and basically carry forward those capital gains into another like kind property. Now, Matthew mentioned that he wants to get out of the real estate business, so probably not going to work. However, there are options for him to roll his gains into an UPREIT, into a Delaware statutory trust. There's some relatively complex structures out there that allow for diversification and, most importantly, securitization, meaning that instead of owning one property, he's going to own a small slice of 100, right? Something of that nature. There's a trade-off there because you do get to continue to enjoy the tax deferral. However, you're not going to be able to roll those gains directly into the stock market if that's the case. So that's a longer time plan. You have to balance the trade-offs of the additional cost versus the tax savings there. But Matthew's got a couple of options to consider.
And our friend Wes Gray always talks about the fact that he meets with so many rich real estate people, and one of the reasons they're rich is because they hold on to the asset for a long time.
Yep.
Because they don't want to pay taxes.
Precisely.
And the 1031 exchange is one way of just continually holding another asset and pushing out taxes as long as they can.
Correct. Yep. Maybe something a little closer to home, maybe something a little easier to manage. But yeah, totally agree.
But
and again,
the thing he says here, though, he says, well,
Yeah.
if I use this account to pay off the mortgage, that frees up other funds to invest and allow my wife to retire early. Just if you're going to pay the taxes anyway, take these investments, take this money and invest it.
yeah,
It's the same thing.
yeah, yeah. The gain will be realized at some point, unless you hold
Yeah,
it
and just
until
pay
you
the
die. So
pay the mortgage off with the money you're already using to pay it off.
amen. I'm with you.
All right, we got one
It's
more.
like Joe Bennett says on The Office, you're an idiot if you're not buying real estate, right?
Duncan, we don't recognize the last 3 seasons of The Office on this show.
Yeah, great
didn't
advice
happen.
from 2008.
Come on.
Thanks.
I mean, they're not as good, but every season's good. Come on.
They had a little shake at the end. It outstayed its welcome. All right,
Okay.
Last
But
one.
not least, not to brag, but my wife and I will both receive pensions when we retire at age 54. Given the pension safety net, why not just put all of our investments into VTI and forget about it? My wife and I have several different retirement and taxable accounts due to various job changes over the years. Everything that is not tied up in employer plans is currently managed by Vanguard. My inclination is to simplify by putting it all into VTI. We will also have our house paid off, and I will be giving my GI Bill to my kids, so no need to plan for those expenses. Double, not to brag. I didn't know you could give the GI Bill to your kids.
I'm going to ask Bill about that too. I've never heard of that.
Follow-on question. At what point does it make sense to move to a more full-service advisor? My wife is a partner in a business and must file a K-1. I think we are leaving a lot on the table by not combining investment advice with tax planning.
All right, I feel like we have a lot of veterans who are in a very good position financially. These questions we've been getting.
Yeah, good to see.
Yeah, so first, Bill, explain giving the GI Bill to the kids. How does that work?
Yeah,
What does that
post
mean?
9/11. Yeah, post 9/11 GI Bill, subject to certain conditions. You need a long time period. You need to still be on active duty at least 6 years. But yeah, you can transfer up to 36 months of GI Bill benefits to the next generation, which is a very powerful tool for long-term financial planning. It's very neat.
That's not a bad deal.
Yeah.
Okay, so a few things here, and I hear this a lot from people. Why do I need an advisor when I can just put all my money into an index fund? And it sounds like that's the beginning question there. Like, hey, I can take equity risk, whatever. But then the second part of it is, well, we also have kind of a complex financial situation here. So does it actually make sense to use an advisor?
For
And-
those that don't know, VTI is just like the total market fund.
yeah,
Is that
total
right?
Vanguard Stock Market Index. VOL is the S&P 500 one. There's like 3 questions in one in this.
Right.
And like, can you take more risk if you have a pension? Do you need an advisor if you can just buy an index fund? And should you combine investment and tax planning? And the big question that wraps all this together is just, is my financial situation complicated enough where I need to let someone else do it for me because maybe I can't handle it? So I think the one thing most people don't realize is that portfolio management is part of the process in working with an advisor. But if that's all there is, they're not a good advisor.
Not adding
They
a lot
should be
of value
doing
there.
way
Yeah.
more than managing your investments.
Right.
And then so the question of, do you need to combine tax and investment planning? You can speak to this, and this is talking your own book here, but the benefits of that, and we've certainly seen that through clients who just say, yes, please do this for me, because you already know the information. Take it off my hands. I don't want to have to go to another person and then back to you and back and forth. Just do it for me.
Yeah, there's no clear answer to the question. I love the idea, though, Ben, of simplifying your life, your financial life. If your decision is I'm going to buy one fund, one-stop shopping, and rely on a government-sponsored pension, I think that's a great solution, to be honest, in the world. There's some hindsight bias there, right? Are we certain that U.S. stocks will continue to outperform the rest of the world, in perpetuity? I don't know. That's
Sure,
unknown.
yeah, but that's a strategy you can stick with. More power to you.
Precisely. And so I think that's a fair point, specifically for a U.S. domestic investor. But Ben, life gets complicated. And even if that's a plan that maybe you can stick to, I love the simplicity of it. I see a lot of value in working with an advisor the more complex your tax situation is. And so I would advocate for that. It's not just our book. It's something we believe in.
Strategically, do you see a problem with not having something to rebalance against? By not having like any allocation to something with bonds or...
Yeah, that could be part of the problem. If as long as you can say I'm going to live off my pension, and I don't have to I don't want to be forced to sell stocks when they're
Right.
down. But that's
true, yeah.
that's certainly part of it, though, Duncan. Is if you're in all stocks and you need the money, and the stock market happens to be down when you need the money, that could be a problem.
Yep.
Yeah.
Liquidity
So,
is
yeah.
a big deal. Yeah.
So,
and I think, Ben, we've gotten a gift of the last 2 years. Everybody's predicting that interest rates are going to start ticking down, but they haven't yet. And for me, it's been a very exciting time in my career to pick up 5%, 5.5%, right, from short-term duration treasuries. Like why do much else, right? That can form a bedrock of a retirement. So there is some advantage, I think, to locking in those rates because VTI is a great fund, but any stock market can decline by as much as 55, 60% in the worst case scenario. There's no guarantee, safety of principle there.
Yeah, but just understand that your portfolio allocation is a much different question than do I need an advisor to help me with these other things? Because those other things, you probably will benefit from getting an advisor.
Yep, could not agree more.
Regardless of what the portfolio looks like.
Yeah, and just quick correction, you need 10 years of service to transfer post 9/11 GI Bill benefits. So.
All right, we have one more thing. John, I have one more. I have a picture here. So yesterday there was a Ritholtz gathering at Barry Ritholtz's house.
We missed
Unfortunately,
you.
the rain. I missed it for the first time in a couple of years. And I got a picture from Michael Batnick saying, hey, who do you think this is? John, can we throw the picture up here? He said, I'll give you one guess. Who is this? And there is a pair of cargo shorts with a phone in the side.
Guilty.
And there is a knife on the belt. And I thought about it a beat. Oh, that's Bill Sweet.
I came prepared. The trick was I needed to open a bottle of Topo Chico. This is not beer. This is not a beverage. But yeah, the folks at Kershaw make a fine knife for cutting chalkboard. Amazon boxes. Those Amazon boxes don't cut themselves, Ben Carlson.
Okay, so you always have the knife on the belt just in case. Which
Just in case.
I don't. Thinking about it, you're right. The amount of boxes that I open that come to our house for my wife and my kids that gets stuff sent all the time. Having a knife on the ready wouldn't be a bad idea.
See,
Great.
Michael didn't give you the joke. He actually called it a pocket protector, and he said, "What is this nerd shit?" That's what he said.
Coming from the guy who wears a fanny pack.
And calls it an F bag. Like the only way to make it worse.
Yeah.
All right. But yeah,
So
that
weird.
I nailed it. That was definitely you. So
Yeah. Well, thank you. Guilty as charged.
all right. Thanks to everyone on the live chat and YouTube as always. Thanks to everyone watching live on Twitter, which is something we've been experimenting with the past few weeks. Lots of viewers there, so we appreciate that.
Over
That's
2,000
great.
people watching right now.
Very nice. Thanks to everyone for emailing questions every week. We have just this endless stream of content for the show because we get such wonderful questions from the audience. Remember, email us, askthecompoundshow@gmail.com. Check out the new Compound and Friends tomorrow. Subscribe, like, rate, review, all that good stuff, and we'll see you next time.
See you, everyone.